Let's have a look at this question. It says Reliable Limited, an electrical component manufacturer, has received a legal notice on 1st of January 2019 from customer A. The customer is taking an action against the company for the financial losses the customer has suffered. Customer A has claimed that the losses incurred by them are due to the issues in products supplied by Reliable Limited in the month of October 2018. The legal team of Reliable Limited are defending the case, claiming the company is not responsible for the losses to customer A. However, considering the progress of the case and other available facts at the year end, which is 31st of March 2019, the management of Reliable Limited is of the view that there are 80% chances or a probability that the company will have to pay damages of 20 lakhs to customer A. Considering the legal case is still pending in the court of law at the year end, the finance manager of the company has not recognized any liability for damages. The case is settled on 2nd of June 2019, and the company has been directed by the court of law to pay damages of 25 lakh. The board of directors in the meeting on 15th of June 2019 have authorized the financial statements for issue. The question is whether the accounting treatment followed by the finance manager, okay, is correct as per the Ind AS or not. If no, suggest the correct accounting treatment for the same, right? Now, this is the fact that is available to us. What you want to remember here is that there are two aspects involved. That is recognition of the liability part, and there is an event after the reporting date, right? So one aspect that we want to discuss is the provisions of Ind AS 37, which is provisions, contingent liabilities, and contingent assets. And then we are looking at, of course, Ind AS 10, which is events after the reporting period. Okay, so let's look at these one by one. All right. Now, importantly, there's a legal notice. Of course, the Ind AS 37 is attracted on that, right? While the legal team is defending the case, they are of the view that there's an 80% probability that 20 lakh has to be paid to customer A. So there's some development on the case over the period of time, right? So what we are saying is that Reliable Limited needs to assess whether there should be a provision that needs to be recognized, right? That's the first principle that we want to address in this discussion. The question is that when do you recognize a provision, right? To recognize the provision, we say to qualify for recognition of a provision, there should be a present obligation and expected outflow and a reliable estimate that can be made for that provision. Okay. Essentially, in our case, in the given case, the three criteria are met due to the fact that from the legal team, there is assessed a probability, right? So we are saying that there's a present obligation available in this case. And then you're talking about, of course, the measurement criteria. A reliable estimate can be made. And of course, there is a possible outflow of resources. So from that perspective, we would say, hence, Reliable Limited needs to make a provision for the best estimate of the legal or of the outflow, which in the given cases, so amount to be recognized on 31st of March 19 is 80% into 20 lakhs, that becomes 16 lakh rupees. All right. Now that is the first angle that we have addressed, or that we have tried to address in the given case. The other part which is important is the event after the reporting period, right, which is in days 10. We are provided that the case is settled on 2nd of June. My reporting date is 31st of March 19, and the authorization date is 15th of June. Now, essentially, we are saying that whether this event, the court settlement date, right, whether it falls under the event after the reporting period date or not. So we are looking at the timeline. And of course, we have 2nd of June 19 as the relevant date. So any date or any event which happens between the two dates, this is my reporting date, and this is my date of authorization, right? So any event that takes place between these two dates, whether favorable or unfavorable, is going to be an event after the reporting period. All right. This means that since the final order has been issued before the date of authorization, okay, Reliable Limited needs to measure the provision in its financial statements for the year ended 31st of March 19 as a confirmed liability, importantly, of 25 lakh. Now, why are we saying that? Because since the indicators exist on the reporting date, which is of course 31st of March 19, that such event could take place, right? The court case is an adjusting event for us, okay, which simply means that the liability needs to be reported in the financial statements for the year ended 31st of March 19 as a current liability in the financial statements. All right, that's how you start to address all these requirements when you're performing or conducting the analysis of financial statement. It has to be a little more detailed. Of course, the focus is very important. The focus is on not just the principle, but also the recognition or the, let's say, the measurement part of it. You can certainly use the parameters, by the way, as a part of the question. You can also try to create, you can also build the journal entries about or around those, accounting. So that's the way you start recognizing that. So we can use those parameters to be able to mention or explain our answers, right? Let's have a look at the formal solution around this. It says that the current scenario needs to be analyzed as per the provisions of Ind AS 37, which is provisions, contingent liabilities, and contingent assets, and Ind AS 10, which is events after the reporting period. A provision shall be recognized when an entity has a present obligation. It is probable that the outflow of resources will be required to settle the obligation, and a reliable estimate can be made of that obligation. Okay. Now, the amount recognized as a provision shall be at the best estimate of the expenditure. And then you refer to the events after the reporting date, which are either adjusting or non-adjusting events. And finally, it's provided that an entity shall adjust the amounts recognized in the financial statements to reflect adjusting amounts after the reporting period. Now, the finance manager has not recognized the contingent liability. Also, the financials are not adjusted to reflect the outcome of the legal case. Of course, it means that the company has not complied with the requirement of each of the standards, both these standards, I would say, right? In the given case, the management is of the view that there is a probability of making 20 lakh rupees payment against the damages, which actually represents a present obligation, okay, arising from the past event requiring an outflow, which can be estimated reliably. And of course, you provide for that. So the initial provision of 16 lakh needs to be made. And since the case is settled prior to the date of authorization, you shall recognize the entire 25 lakh as a current liability. It becomes a confirmed liability for you rather than remaining a provision altogether. All right. Let's have a look at this question. It says that Arun Limited is an entity engaged in plantation and farming on a large scale and diversified across India. On 1st of April 2018, the company has received a government grant for 20 lakh rupees, subject to a condition that it will continue to engage in plantation of eucalyptus tree for a period of 5 years. The management has a reasonable assurance that the entity will comply with the condition of engaging in plantation of eucalyptus tree for a specified period of 5 years, and accordingly, it recognizes a proportionate grant for 4 lakh rupees in the statement of profit or loss as income following the principles laid down under Ind AS 20, accounting for government grants and disclosure of government assistance. The question says, evaluate whether the above accounting treatment made by management is in compliance with the applicable Ind AS. If not, advise the correct treatment. Now, on the face of it, apparently, it looks like a correct treatment, right? You receive a government grant, you have a reasonable assurance, and you recognize it, of course, over the period of time, right? But importantly, you want to remember that whether this grant is covered under Ind AS 20 or it's a grant which is covered under Ind AS 41, which is agriculture, right? Now, this is important because here under Ind AS 41, the requirement of the standard suggests that no grant may be recognized unless the conditions attached to the grant are complied with. Okay. No grant may be recognized unless the conditions attached to the grant are complied with. So if I say the condition is to, for example, engage in the plantation of eucalyptus tree for 5 years, the grant can only be recognized after 5 years, assuming that during those 5 years, the condition with respect to the plantation of eucalyptus trees taking place. It has to be a firm case, the completion of a condition, rather than purely on a reasonable assurance, right? That's a key difference between the grants recognized under Ind AS 20 versus the grants recognized under Ind AS 41. All right. Now, that suggests to us whether this, in this given scenario, this grant is an example of, right? Now, this grant is falling within the perspective of Ind AS 20 or Ind AS 41. Now, since the company is engaged in plantation and farming, we may agree Arun Limited is in agriculture business and it is likely that the grant is of or is for conducting the agriculture activity. Okay. Therefore, the grant can only be recognized in the books of Arun Limited as income after completion of 5 years, right? So until then, of course, it becomes a part of to be recognized as deferred income. So for the 5 years, it will be recognized as deferred income completely, right? For the first 4 years, it's a non-current liability. And in the 5th year, it becomes a current liability, right? The only exception to that is, however, if the government allows a partial recognition on a pro rata basis of time, right? Then Arun Limited may recognize rupees 4 lakh as income at the end of each year. So that's going to be apportioned over a period of time from the recognition of that income under the grant. And the grant is, of course, is an agricultural grant. That's what you want to remember here. Okay, so that is a very straightforward small equation. The key is, importantly, the key is I need to be very, very sure. I need to be very clear about it, whether this grant is a part of, let's say, the Ind AS 20 framework. Of course, the question states that, or is it going to be a part of, let's say, another standard? Okay, which in our case, of course, is applicable in Ind AS 41 agriculture. All right, let's have a look at the formal solution in this given case. It suggests that Arun Limited is engaged in plantation and farming on a large scale. This implies it as an agriculture business, and accordingly, Ind AS 41 will be applicable. Further, the government grant has been given subject to the condition that it will continue to engage in plantation of eucalyptus tree for a coming period of, or for a period of 5 years. Now, this implies it's a conditional grant, and then you're referring to the government grant should be recognized in profit and loss when and only when the conditions attached to the grant are met. That is, there is a continuous plantation of eucalyptus tree for the 5 years period. Accordingly, it means that the grant shall not be recognized until the 5 years have passed. Okay, so the treatment done by Arun Limited is not correct. It has to only recognize the entire 20 lakh rupees after 5 years of time, once the conditions are met. However, if the terms of the grant allow a part it, to be retained according to the time elapsed, that's what we're looking at, the pro rata appropriation. The entity recognizes that part in profit or loss as time passes. Accordingly, of course, they can recognize a grant of 4 lakh rupees on each year basis. In general, this would be otherwise considered to be a part of non-current liability under the heading government grants as a deferred income. All right, that's it from my side. Thank you very much.